for inviting me. Again, I'm Andrew Syrios. I'm with Stewardship Investments, and we are a buy and hold real estate investment company pretty much throughout Kansas City, both sides. We mostly do Jackson County. We mostly do houses, but we do apartments, and we've gotten more into that, or we're looking to get more into that as well. And so I'm going to give sort of the BRRRR strategy, which is our favorite strategy, the buy, rehab, rent, refinance, repeat strategy, but apply it more to apartments, because there are some differences in that regard. There are some houses I kind of like more in a way because they're more cookie cutter. They're easier to evaluate. They're easier to know this is what the value is, this is what the value will be, this is what the rehab will be. The rehab will all be up front. Apartments aren't really like that, especially if you're buying one that needs to be repositioned a little bit or a lot. So I guess how many people in here are actively investing in real estate? I didn't actually make a count. And how many are either looking? How many own an apartment? Say something over 4 units. So just a few. Okay. How many over apartment over 10 units? Okay, just.
Apartment you're talking about, or
what's that?
Or fourplex?
It's something that's over 10 units. So okay. So we got a couple. And one roof, or one parcel. So like it could be an apartment with several buildings, but it's the same apartment complex. Okay. What's that?
Just lots of fours.
Lots of fours? Okay, good. Yeah, I mean, the duplex to fourplex is kind of an interesting, I almost value those more as houses, as I do with houses, looking more at comparables as best I can. Or it's kind of that in-between area. There's this, it's sort of the gray zone between the house, which is like, I'm just looking for the buy part. The first part about, and by the way, feel free to raise your hand at any time. We'll make this as interactive as possible. See how far we get. So if you have a question, we'll have some at the end too. But if you have a question over there, and just raise your hand, and we'll go through it that way. But I mean, the first stage is the buy part, and so it really is important to not just be whatever comes your way. I mean, if the greatest deal ever comes your way, that's something it's just a plot of land, and you're not a developer, but they're selling some lot in Mission Hills for $5,000. Yeah, buy it. But you want to focus on your primary strategy. So what are you looking to buy? And so the first thing is like where. And we have really focused on sort of working class to middle class, with probably lower middle class being our primary target. So our markets are areas like Grandview, Raytown, the South Waldo area, south of 89th, and west of Troost, west of Holmes, near the old Bannister Mall, things like that, the older parts of Lee Summit, those sorts of areas. Now you can pick, like maybe you want more luxury rentals or something like that. I think the best bang for your buck is kind of in that lower middle section. That's where you'll get the best cash flow. You will still get appreciation. There are plenty of good residents. If you're going too low, just buying as cheap as possible. When we first came to Kansas City, I had this dollars per door thing in my mind. Like I want to be under $20,000 a unit for apartments. That is not a good way to think because those types of properties usually look nice, but they only look nice on paper. Oftentimes, especially if you're buying in really low-end areas, unless you specialize in it, you're really good with Section 8, really good at screening, really good at securing the property, things like that, knowing what the kind of the pockets, you're going to get those properties. Usually, one, you'll rehab out the equity. So like if you're buying a house for $10,000 that's worth $40,000 and it needs a giant rehab, you put $30,000 into it, you have no equity. Whereas if you have a property that's worth $100,000 and you're buying it for $60,000, $50,000 or something like that, $30,000, all of a sudden you still have $20,000 equity. So you rehab out, roof costs the same on a house that's in a D area than a house in an A area. There are some differences. Obviously, you're not going to put granite countertops in a house that's on, Skid Row and Warzone. But you are, for the most part, the rehab does not go up. The cost of the rehab does not go up at the same rate as the cost of property for the nicer areas. And then once you get in the nicer areas, it's usually you're competing with both investors and you're competing mostly with homeowners when you get into nicer areas. And so the rents start to go down compared to the price, meaning it's harder and harder to cash flow. So that the best area is sort of the lower middle in our judgment. And that's true for apartments and for houses. And so picking those areas where you're looking for, that is the first step, the primary areas you're looking for. Yeah, if you find if you find something that's in a really, that just seems incredible, but it's not in one of those areas, the way we think of it is it's got to be a better deal. So like we want to be at the absolute maximum driving distance from our office. We want to be 30 minutes at the most, but we want to be within 15 minutes. If it's 45 minutes out, we'd probably want to just buy it and flip it. So it needs to be an even better deal. If it's 30 minutes out, it needs to be better than if it's 15. Like 15 minutes will reach a little bit more than we will if it's 30 minutes. So you want to kind of keep these things in mind. You want then the what. What are you looking for? Are you looking for houses? Are you looking for duplexes to fourplexes? Yeah.
What's your reason for the distances? Is that just ease of maintenance or what?
Ease of maintenance, ease of leasing, ease of rehab. I mean, it's just one of our probably biggest challenges management-wise, we manage our own properties, is how spread out we are. And that's just, Kansas City is like, I read somewhere it was like the most highway, like miles of highway per capita in the country. It's one of the most sprawled out cities there is. So it's partly just like that's what the hand we're dealt, but we don't want to, every minute a leasing agent's in a car, every minute that a maintenance tech is driving between one property and the other is lost money. So it's more and more difficult to manage those types of properties, and we don't generally like hiring third-party management, and especially since we have our own management company, it doesn't seem to make sense. So that's the main reason for that. So if we found a great house in Leavenworth, we'd probably flip it or something like that. It just came down the track. But the what is, yeah.
You talking about a little bit of your business model, but can you give me an idea of for every certain amount of income, net income, let's say you have 10,000 net income after you pay the notes, how much do you spend on staff, service, repairs? Is that
Like on a property basis?
for your portfolio? Does that make sense?
Like what percentage goes to which parts of our expenses?
Let's say you net 100,000 in income in a year. How much percentage would be for expenses?
Not including income. I mean, for an apartment, it's going to be usually about 50%. Ours is going to be a little bit higher than that. For houses, probably more like 60. And then you've got your net, your debt service. I mean, we don't have a lot of cash flow. We have some, but not a ton. And that's our goal is not. I mean, cash flow is nice, but especially in Kansas City with houses, we predominantly have 20-year mortgages. So we don't have as much principal pay. I mean, we have a lot of principal pay now, but that makes our cash flow less. So, we have enough cash flow to pay all of our expenses. Probably 60% is about, not including debt service, is about 60%, and that's good, except for so we get lots of principal pay down, appreciation, those sorts of things. But built-in equity when we purchase and stuff like that. The magic number when evaluating an apartment supposedly is 50%. Your expenses will be 50% of your income. That's a good rule of thumb, but we'll get into that a little bit more. I wouldn't trust that. That's just like a quick note when analyzing. But with the what, I think one of the biggest questions you want to ask is how much rehab are you willing to do? Like if you're buying a house, like we are willing to do like a house that's pretty much needs to be gutted, that's fine, we'll do that. But an apartment, like a 20-unit apartment complex that has no residents and needs to be completely gutted, I would have to get that for a song to consider it, because it's a really big project, and the bigger the project, the more risk you have, especially if you're dealing with something that needs a giant rehab like that. Now, we would probably, our goal with apartment complexes of that size would be a minor reposition. So something where it's like, let's say it's 20 units, it's got 14 residents, 2 are playing late, it needs a bunch of TLC all over the place, it looks really drab. Something where we can bring it up from here to here, not from here to here. So that's kind of how we think of it. And I think you want to have it's not like this is not set in stone, but this is your primary strategy. And if it's going to be outside of that, then you want an even better deal because it's riskier. When you're looking at analyzing houses and apartments, I would say analyzing houses is much easier because, especially if you have access to the MLS, is you just look at, you're trying to basically take this comparable sale and make it exactly the same as the house that you have. So if this house is just slightly smaller, it has half of one, your house is 2 bathrooms, it has 1.5 bathrooms, it's sold 6 months ago, then okay, well it's a little bit worse. So if we made it exactly the same, like we somehow magically gave it a full bathroom instead of a half bathroom, and made it sell now instead of 6 months ago, it'd probably sell for let's say 10,000 more. So you're just looking at it that way, and you're finding the most comparable houses that you can. And sometimes it's incredibly easy. You're just in a neighborhood where every house is the same, and there are a bunch of houses right next door that sold. This is like condos. It can be extraordinarily easy, especially if it's in a complex and there's your 3 neighbors have the identical condos sold. Yeah, it's probably that's the value. You've figured it out. Apartments are not as cookie cutter because there's really no way to compare a normal 20 unit apartment complex to the rest of the 20 unit apartment, the 20 unit apartment complex with 12 2-bedroom, 1-bathrooms and 8 1-bedroom, 1-bathrooms that has the 2 bedrooms are 800 square feet and the 1-bedrooms are 620 square feet, and it's got a mason roof and it's got a swimming pool. All these things. Compare that to all of the other apartments that are 20 units with 12 2-bedrooms that are 850 square feet, and so there just aren't any others. There might be one or two, maybe, but probably not. There just aren't comparable sales. So we want to boil it down to its cap, basically to its cap rate. And what I don't know, probably most of you know what a cap rate is, but I'll just briefly recap. The cap rate is your net operating income divided by the total price, the total value. And there are a couple problems with this. This sounds like the simple one-size-fits-all solution. So like the property makes $100,000, it's sold for $1 million, it doesn't require any rehab. That's a 10 cap. $100,000 divided by 10 is 0.1. You multiply by 100, it's 10 cap. So that would mean if you had a similar apartment in a similar area, so it's relatively similar size, similar area, similar quality, and it sold for $1.5 million, but it was an 11 cap. That would mean that the higher the cap rate, the better. So that would mean that one was actually a better deal, even though it was more expensive. It's just like, so you're not really looking at the price as much. You're not looking at the number of units, the price. You're looking at that cap rate. There are a lot of things you need to look at here. For one thing, things can be hidden on operating statements. So you want to look at very carefully. First of all, whenever you're evaluating an apartment complex, you want to get the operating statement. You want the real numbers. You don't want to rely on the seller-provided pro forma. They will always give you a pro forma that is optimistic. They will always have the occupancy over 90%. They will always get it there. The expenses will generally be lower. I mean, some of them are reasonable, but they're always going to be at least optimistic, and sometimes they're absurd. And so you don't want to rely on their pro forma. You want to make your own based on the actual history of the property. And so the shortcut way to do it, this is from Joe Fairless, which I like, is just take their expense or a base number that you can determine. That's sort of like, and if their expense is above it, then you take that. And if their expense is below this kind of the base number that you would think, you take that. So there's 10 categories in the expense category is the really one that really matters. The one where stuff can get hit the most. So I'll get into the income in a second. But there are 10 categories. The first one is just taxes, and you just take the previous year, or you take whatever the county says. And then you have the insurance, and you usually take what they have, or you can get your insurance company to bid it out if you get further along. The utilities, you take what they have. Now you might be able to improve this. Perhaps they have a leak, maybe their utilities are really off the chart or something like that. This could be a good value add to the property. But generally speaking, the quickest way to do it is just take what their utilities were the previous year, maybe add a tiny bit to it, just assuming a little bit of inflation. And then the management fee, and this would depend on whether or not it's off-site or on-site management. And so on-site management usually begins probably around 40 units, thereabout. That's when you have a manager at the property. We've seen ones with 30 units that have it, but probably around the 30 to 50 unit is when you start having on-site managers. Lower than that, like a 10-unit apartment, you would never have an on-site manager, or maybe you'd have a part-time on-site manager, but like a big company wouldn't, generally speaking. They'd have an off-site manager just in the same way you'd have a house. Like for our apartments, our apartments are generally between 4 units, and our biggest is 32 units. All of them are off-site management. The 32 unit, we could maybe justify putting a manager there if they also did the maintenance, but that's a very unique set of skills. So we manage that from our own side. If it's off-site management, it's usually 10%, and then also either half of full month's rent for all new leases. If it's on-site management, it's usually about 4%. And then you also pay all of their payroll, and we'll get to that in a second. And then you have the variable expenses. The first one is repairs and maintenance, and the second one is contract services, and often these are kind of lumped together. So contract services would be like landscaping, snow removal, things like that. Repairs and maintenance, all maintenance and all turnover. And so usually our base ranges from about $500 to $700 a year per unit for repairs and maintenance, and depending on the size of the unit generally, and about $200 to $400 contract services. And so if they have less than that, then you just bump it up at least to your minimum. If it's more than that, I'd keep it where it was when you're putting together your pro forma. The next one is general administration. This is things like phones, letters, mailings, anything, all the basic expenses that come along with things. This is often kind of like, it's more for on-site. If you're off-site management, obviously you don't have phones and stuff like that on the property. But usually that still, we put that about $100 to $250 a unit a year. Then marketing, I usually do $50 to $200. We don't do much marketing since it's like Craigslist and rent links and stuff like that, and most that's either inexpensive or free. And then it's payroll, and it's usually, now payroll is only for on-site management. If you don't have on-site management, you don't have payroll. You're not going to be able to sign all of your, like if you have we have a staff, but they don't, it would be impossible or extraordinarily difficult to take like what percentage of their time was spent at each property. So we just leave that off and have a higher management fee. And that's usually $700 to $1,100 per unit per year. And then CapEx, which is, it's either replacement reserve or recurring CapEx. And this is the biggest and trickiest part. Recurring CapEx is anything, the way accounting splits things up. You have your operating expenses and your capital expenses. And the quick way to think of this is operating expenses or capital expenses are anything that basically should last over a year. So like if you replace your furnace, that is a capital expense because that will last some time. It depreciates over time. The roof is like that, the parking lot. Operating expenses would be like repairs and maintenance, things like that, yeah.
So that's true for houses, but not necessarily for apartments.
That's true for both.
So
Yeah.
if I own a 10-unit property and I replace a furnace, I don't have to capitalize that.
You don't have to.
Because I'm replacing 10% of the...
Each furnace itself is considered a separate unit. So it's not like your furnaces, like accounting-wise, it's not considered like the property's furnaces. Each furnace itself is a separate capital asset, and each one itself would depreciate over time. Now, the accounting part I wouldn't worry about. The most important part we have to look at is what recurring capital expenses. Like this is effectively an operating expense. Like what you're saying, if you have a furnace go out a year, and you can expect a furnace to go out a year, if a furnace lasts 25 years, you have 25 units, one furnace will go out a year on average. So that is a capital expense technically, and the capital expenses, not to get too accounting-ish on you, capital expenses don't go on your operating statement. They don't go on your profit and loss statement. They go on your balance sheet, and only on your balance sheet. And so the problem with this is if you have recurring capital expenses, it makes your profit and loss statement look a lot better. Now that might be good for you, but it's not good when you're looking at somebody else's operating statement. You want to know how much are they spending on capital expenses because the easiest way for them to hide that a property is actually doing badly and make it look like it's doing well is to take all of the operating expenses and just put them on the balance sheet. Just leave them off. So you want a list of their capital expenses. You always want to do this. And you want to look through it like, one, are they capitalizing things that are either ridiculous or on the margin? Like if they're oftentimes, they'll capitalize replacing carpet. They'll capitalize painting units. Okay, you can justify that in an accounting sense, but this is a common expense you're going to have to do over and over and over again. And if you think that you're not going to have to work like that, that comes out of cash flow. So you want to put in, first of all, see what they're doing there, when just to evaluate their operating statement, how well they're doing, and then you also want to account that during when you're putting together your pro forma, how well your property was going to do, how well you think it's going to do. You want to make sure to put in a capital expense. We usually put for apartments about $250 to $350 a unit, depending on how big the property is, whether it has common areas. Common areas will add to that expense, and also how old it is. Yeah, did you have a question?
Yeah, I was just going to ask. I know exactly what you're saying after having looked at all these statements, from sellers. I'm interested in hearing what they have to say on paper, but on the other hand, I'm also inclined to just disregard it as being unreliable. Is that a fair assumption? And then calculate my own numbers.
I would kind of say both. The big thing is,
Literally throw it away.
Yeah.
I want to see what they have to say, but I need to verify it.
Yeah, absolutely. I would say the one thing, that trick that Joe Farrow's talking about, he's got a book called his books are weird titles, like the greatest apartment syndication book of all time or something like that. I don't know. But his rule about this, where you take their number if it's higher than your base number, and if it's lower, take the base number. And I like that as a general rule of thumb. That way it's like, because there are properties that have, the old properties that have, these old wooden windows that are barely holding on, where you can kind of think you can poke your pinky outside, because there's that gap between the windowsill and the glass, where the utilities are through the roof because it's so poorly insulated. And it's like, well, if you take your base number, it's not going to work. If you take I think utilities should be approximately this. That's not going to work. On a house with windows that bad, you should plan on replacing the windows. But I think it's kind of both. You take their numbers, but be conservative with them, and don't ever. It's the same way. You don't take their pro forma, but sadly, don't really take their operating statement at face value either. And always ask for their list of capital expenses as well, because at least for a year. One of the things, like sometimes you don't even get anything from them, especially if you're dealing with kind of a mom and pop property owner. They don't even really have an operating statement. They have here's the list of expenses I've had for the previous year, and I got to reconstruct it. I always think it's best to kind of have both. Put together what they have and use that as sort of the skeleton to put together your own pro forma with. And then with regards to the income side, I always like looking at what they have now, because usually when you're buying an apartment complex or anything, if it's rented, it's a bit under rented, and it also needs more work. So it's like everything goes up when you buy it. Do your own market. You want to do if they say the rents can be increased, okay, but whatever. It's kind of the same thing you're talking about. I'm glad you told me that. I will verify that and see what you're looking at. Some good sites. I like going. Actually, my favorite is just go to Craigslist and just go to the map feature and look at any apartments nearby and what they're renting for. Drive around, call. You can call for rent signs. Rent range is cost a little bit, but it's got some good data that you can get from that. It just kind of gives you a list of comparables and kind of see whether there is some room to move it up. Usually, if the property is a bit dilapidated, you can increase the rents once you fix it up. But the general way, if the property is already fixed up and they're under rent, you shouldn't assume that you can just raise the rents, especially if it's got 20% vacancy, 30% vacancy, because the general way you do it is once you've hit 90, 95% occupancy, then you raise your rents. Like that, you don't raise your rents when you're at 60, 70% occupancy. And so if they're under rented and the property's in decent shape, then you probably can't raise the rents. And then as far as, you want to, if they're running at a really high occupancy rate, or they say on the performance is 5% vacancy, unless you're in luxury apartments, you probably should assume it will at least be 7.5, and we usually use 10, because one, you're counting economic vacancy when people, don't pay you rent and stuff like that. Now the expense of actually filing an eviction, that's part of general admin. But if people don't pay you rent, that you have somebody's missed payments, or just that time period between them moving out, turning over the unit, and re-renting it. Just the time period between when somebody puts down a deposit and then actually moves in. We have 2 weeks. You have 2 weeks before when you put down the deposit, you have 2 weeks to move in. Right there, just even if you're running it just perfectly, you're still probably going to be about 95%. So if they have a 5% vacancy, I would bump that to 10%. Again, you want to be conservative with these numbers. And then you also want to look at what cap rate are you looking for? And back when we started, we were looking for more like a 10. Now it's more like an 8. In nicer parts of Kansas City, there's no way you could get an 8 unless you're just getting a complete steal. In California, in San Francisco or Los Angeles or New York, you're lucky you get 4. And so but even when you're comparing to other properties that have cap rates, it's a little bit trickier, because this property sold at they'll say it sold at an 8 cap, but how much rehab did it need? There's nowhere you're not just going to be able to see on the MLS or CoStar or any other site how much rehab was put into the property, because if you just look at the price as what you're using to evaluate your cap rate, well, that's not the whole picture. It's the price and the rehab. That's the total cost, and I always calculate my cap rates off the total cost. So in a lot of ways with apartments, all this data you want to get, but there is an art to it. You're not going to be able to get, I wanted this when I got started. It's there's just this perfect calculation that if I run the numbers like this, I'll know exactly what it will be. And with houses, you don't even have that, but with apartments, it's even further away from that. So there's sort of a, like going back to Joe Fairless doesn't really comp out areas that much. He picks the type of areas he wants, then he aims for at least an 8 cap and a 14% cash on cash return. That's his numbers. And I think that's kind of the way you want to look at the comps nearby. You want to see what they sold for. You want to see what they rented for, and you can kind of get an idea. And also their amenities. Look at are they paying all the utilities, or are the residents paying the utilities? If a property is paying all the utilities, the rents better be higher on it. And so you look at all of these things and kind of compare them like that. But you're also, with apartments, you're more looking for that. Looking for what is your cap rate? What is your cash on cash return? Do they meet your expectations? And this is one of the things that makes the BRRRR model not quite as applicable to larger apartments. And that is, appraisals on these larger apartments are going to be a little bit harder it's harder to know exactly what it's going to be. It's harder to know exactly how much value you're going to add. There's easier to add value to an apartment, because if you are able to increase the rent substantially, that increases the value of the apartment. Whereas if you increase the rent of a house, that actually doesn't increase the value of the house, because appraisers they are looking at comparable sales. They're not looking at how much cash flow a house brings in. But appraisers are looking, for apartments, they are looking at how much cash flow and what is the cap rate of an apartment. So you have more control over the value, but it's also harder to know exactly where it's going to come in. And so it's a little bit trickier to know that. And so that makes it like the refinance out part. Because the BRRRR model is all about buying for 75% of the value and then refinancing, or less, preferably less, but at least 75%, and then refinancing it out with a bank after you've done the rehab and rented it out. And that way, since they will lend you 75%, you bought it for 75% of the value, you have no money left in the property, and basically have a free house. Well, that would be great with apartments, but it's a little bit trickier because you would need more cash reserves, I think, with apartments. You need more, like if you're going to leave money into it, if you're buying it with your own cash. Now, there are other things you can do. I know you used to work with the Woosters, and the Woosters do a lot of syndications. And so just kind of moving into the financing side of it. Syndicating apartments is, you can't, well, I guess you could conceivably do this with houses, but the syndication is where you bring in private, it's like bringing in, like what we do with our houses, we get private loans from various individuals, and we usually pay them 8 or 9% interest only. We finance up front before we've done any of the rehab, most or all of the purchase in the rehab. We do the rehab, then we get it rented out. Now, the goal is to be all in for about 75%. We're not quite, I think our overall average is about 81%. So we're close. We leave a little bit of our own money in. And then once we have a handful of those together, we take 5, 10, 15 even. We bring those to a bank and we have them refinance it as a package. Now, you could do it just as one, you could do it as 2, but we found it easier just with the number of houses that we buy to bring it as a package. With apartments, you can kind of do the BRRRR strategy without refinancing it at all. And that is by bringing in, instead of private lenders, you bring in private equity investors. And so they put up, like the Woosters did a lot of these. You'd buy, so let's say you're buying a 100-unit apartment. It's $4 million. So you get a $3 million loan, and you have to raise $1 million of equity. And so you bring in people, and basically what you do is you share that equity with them. You're creating a security. This is getting a little, this is talk to your attorney, right? This is not, it does cost some money to do these things, but instead of giving them an interest rate, you actually give them a percentage of the equity. And so what they've done and what various syndicators have done, I mean, like Ben Leibovich does this a lot. He writes for Bigger Pockets. You can see his stuff. Joe Fairless obviously does this. Is they usually take between 15% and 30% of the deal themselves. Maybe they put a little bit of their own money in, but you don't have to. And then they give out 70 to 85% of the deal to their private equity investors. and the private equity investors will usually sign on the loan as well. Now, many of these times you get loans with big banks, the U.S. Bank, Bank of America, Fannie Mae, Freddie, they have programs like this. And you can actually get non-recourse loans where the only asset that the bank can come after if you did get foreclosed on was the property itself. But they will usually have to sign on the loan as well. And then that way, once you've pooled all this money together, you buy the property in its separate LLC that is basically this separate business owned by this group of investors, with the lead being yourself, and then all of your passive investors that put together the money for the down payment. Now, when you're doing that, you want to budget for the rehab really well if you're going to be doing a rehab, because there's no refinance plan. You're basically doing all of it up front. So it's like the BRRRR with one less R, or the BRRRR with finance or something, I don't know. But it's very important to budget all of the rehab up front, because you're not refinancing on the back end. And you wouldn't want to, because commercial refinances are extremely expensive. Commercial appraisals are much more expensive than home appraisals, and if you're paying 1 point for a loan that's $100,000, it's okay, it's $1,000. If you're paying 1 point on a $4 million loan, that's significantly more. So you don't want to be doing a refinance after refinance after refinance. You certainly don't want to plan on refinancing an apartment complex if you're syndicating up front. I mean, well, maybe sometime down the line, sure, but not in the next year. So, and banks will they'll escrow that rehab money usually. So if you give them a budget with kind of a line item of what you're planning to do, then they will keep that. They will finance that the whole purchase, or the 75% of the purchase, and they'll leave the rehab money in escrow, and then they'll give you draws on it. So once you send them, they'll demand, like, maybe say they'll give you 3 draws, and at certain points you have to send them invoices, maybe pictures, things like that, and then they'll release that money for that additional part of the rehab. But you certainly want to get that in there up front so you can do everything you need. I have heard stories of investors under budgeting their rehabs, and then they usually have to go back to their private investors in this case and ask for additional draws. And I mean, you want to tell them that this is possible going in, but it's not going to be a fun conversation. And so investors usually don't like hearing that they need to put in additional cash. I guess I'll talk a little bit on financing for, in general. This is the last part of the BRRRR strategy for us, but I'll move it to this part. My favorite way with regards to houses of finding new banks is really just to ask around. I think these rooms are the best place to find banks. I mean, if you ask me for the list of all the banks we've used, I'd be happy to give it to you. Now, if you ask me for all the contractors we've used, I can't give you that. That's proprietary. But banks, I've never seen anyone having a problem like telling all the banks they've had successes. Like we've had success with Bank 21, with Tri-Century Bank, with Fidelity Bank, with Cornerstone Bank, and I like giving their name out. The more business I give them, the happier that makes them, and the more likely they are to lend more to me. So those banks are great, especially for houses, because big banks generally don't like lending on houses. They don't like lending on, well, they will for homeowners. But U.S. Bank, Wells Fargo, they will virtually never lend to a single family investor, who's got 12 rentals or something like that. They want homeowners and big apartments and commercial properties. So with commercial properties, the big banks are certainly in play. Mortgage brokers, it's worth looking around a lot, I think, and it's worth going through talking to mortgage brokers and seeing what options they have available, because it's a lot more. You pay 5.5% instead of 5.25% on a house worth $100,000. It's not a big deal. On an apartment worth $4 million, every single step of the way, every little thing it's compounded, because we're dealing with bigger things here. And so I would certainly, again, asking around these rooms even for apartment loans is certainly a good idea. But I'd be much more interested in talking to mortgage brokers, and things like that as well, just trying to see what all the options are available. And because a lot of bigger banks, bigger institutions are interested in those kinds of things, where they're generally not in houses. especially in the Midwest. Yeah.
Could you repeat those bank names again?
Yeah, sure. Our four favorites, the ones that we've done the most business with, are Bank 21, Fidelity Bank, Cornerstone Bank, and Tri-Century Bank. Yeah, absolutely. Tri-Century, yeah. So yeah, we're just we've been really happy with all four of them. And so yeah, I'd say when you're doing these loans, I would say with private lenders, we're always looking for private lenders, and just kind of the best way to do it, one is networking, and two is just kind of always openly state. You don't have to openly sell people, but like if somebody asks you what you do, well, I'm a real estate investor. We buy houses, fix them up, and then we buy houses, we get loans from private individuals paying 8 or 9% interest, and then we fix them up and rent them out. And that can lead to further conversations. You can also, I think one of the best tips I've gotten, this was actually from my father, but is just to sit down with a pen and pad and write down 20 names, or 20 people who might be interested in lending you money on a house or something like that. Some people who you think might have $50,000 to $100,000 to lend. If you get 20, you can get 30, and then you start, you can get 30, you can get 40. And then you start, talking to them, invite them out to lunch. No high pressure sales tactics. If you've done a rental investment or two, kind of create a little packet that has, this is our business strategy. This is kind of my resume with the properties we've done. This is what we're looking for. This is the kind of deal we'd want to do. This is what we're offering. And you can do the same thing if you're looking for apartments and you're looking for syndications. And now there are a couple rules with regards to marketing for syndication, so you look into it. You need to have you can't pitch somebody a deal unless you have a pre-existing relationship with them. So you want to meet with them first and actually get to know them before. Or you can tell them what you do and what you're looking for, but you can't sell them on a deal until you have at least had one contact with them. And then once you have a property under contract, put together a long, pretty much like a sales package. Like if you were going to list a property, put together an entire package like that in the exact same way. You're saying, this is where the property is. This is, these are all the details, how many units it has. This is his operating statement. This is what the pro forma we think will be. These are what the returns we think will be. This is why we like it. These are the demographics of the area. These nice slick packages. A lot of it, there is this aesthetic thing. Some of it is the actual numbers, the actual thing, but it's if you come into a job interview with this sterling resume, but you're dressed in like a t-shirt that's just covered in grease and like shorts that are from the 90s that are just all ripped up and haven't showered in a week and stuff like that. You're not going to get the job. And if you come in even without the greatest resume, but you're very slick and well presented, you very well will. And so a lot of it is just the presentation, and like it might seem a little bit like fluff, but spend a little bit of money, go to a nice shop and get it bound, your packet bound. Don't just give them like a couple of pieces of paper that are stapled together or something like that. The same thing is true with banks. You want to definitely schmooze the lender you're dealing with. I mean, this is not about being fake. People see through fakeness, so you do want to be genuinely interested in what they have to say. But take them out to lunch. Really kind of sell your own business model, sell your vision. Be passionate about it, because with a lender, with a private lender, obviously they're the ones who makes the decision. So you've got to present yourself well to them. Now with a lender for a bank, they might not be making the decision, they need to go to committee, but they are the one that are selling you to that committee. And if they don't really believe in you, you will get shot down every time. And so when I present a lending packet, all of our documentation to a lender, I usually do it through Dropbox or Google Docs, and I have just everything I could think that they'd want. Or I give it to them on a flash drive. So I've got our business plan, our company financials, our resumes and things like that, the properties in the portfolio. I have the rent roll, the profit and loss statement, the pro forma, pictures of the property, all these things. Some of them, they're going to go take pictures themselves. They're going to get an appraisal. It's not, they're not going to ask for pictures of the property. they're not going to ask for your resume generally, but including these things into a nice, well-organized package makes you come off as professional, trustworthy, you know what you're doing, and that sells both. It sells directly to any private lender or potential private investor, and it sells lenders enough to sell you to the committee. So these things it is important how you present yourself. It's not just whether the deal is good or not. They're looking at both things. They're looking at whether the deal is good or not, and whether you seem like a trustworthy borrower or a trustworthy investment partner as well. And so, yeah, I mean, I think it's kind of one of those things, like if you're looking for potential investments, you're always sort of looking. You're talking to wholesalers, talking to real estate agents. Maybe you're sending out letters, sending out text messages or whatever. And you can do those things with apartments too. It should be the same with investors, lenders. You're always talking to people. You don't be annoying. I can't stand those people who are always like, they sales pitch to every single person they know. But always let people know what you're doing, and don't. You should be loud, real estate investor. At least everyone should know you are and know what you're looking for. So, I don't know, any questions about like financing or that come to mind too before I move on to rehab? I know it's a bit of a messy topic because there's so many moving parts with regards to financing an apartment complex and how you're doing it. Are you doing it yourself? Or are you doing it with an investment group? But it is, I would say, I guess just general principles. One, syndication is generally going to be difficult unless you have some reputation, some things that you can. Like I've bought a few houses or something like that. So that's probably something you want to work your way up to. Yeah, hey Aaron.
Hey, so how long does it take typically from the time you find a building, and in terms of syndication, how long does it take from the time you find a building to the time you actually get the property into your hands, buyer and seller shake hands, close on the deal? How long does the process typically take?
Yeah, with a house, you usually close in 30 days, sometimes less if somebody wants a speedy sale. Apartments are usually a 60-day close, and what we do is we have basically a 30-30-30. And so whenever we submit a contract or an offer to somebody, we have the contract says 30 days for an inspection period, and I was about to go into due diligence actually, so we'll talk. This is a good segue. 30 days for an inspection period. This is the period when your earnest money is refundable. So we're going to do all our walkthroughs. We're going to look through all of their leases. We're going to do any inspections that we think are necessary. And if there's a major problem with the property, we'll either retrade and ask for a discount, or maybe we'll just walk away. Then 30 days to close, and that would be when you get your financing in order, you get all your syndication partners in order. And then what we have is a 30-day, the built-in opportunity to basically put down additional earnest money to extend the contract 30 more days in case the bank is taking a while or any problems like that. So we don't want our earnest money sitting out there in the wind if we have some hiccup that's going to take an extra 10 days to close. And so we have that. So our contracts are built 30 days, and then 30 days during the inspection period, 30 days to close, and then the possibility of putting down an additional earnest money, usually just the second earnest money, whatever it was, to extend the contract an additional 30 days. With houses, it's usually 15 and 15, like 15 days to inspection period or thereabout, and then 15 more days to close. With apartments, bigger commercial properties, it's usually 60 days. And then occasionally it can be longer. If it's in a really complicated, big 20, 30, $40 million deal, it might be longer than that. But the ones we've dealt with have been 60.
Are you guys doing like phase 1 environmental assessments?
On large apartments, we would. On a 10-unit, probably not, unless we thought there was a reason to do it. Phase 1s can be fairly expensive. I can't even remember off the top of my head how much they usually cost. But yeah, phase 1 is an environmental inspection, and then there's also phase 2 that you'd do if you found something. But phase 1's, I'd say on any apartment probably over 50 units, we would do a phase 1. Unless it's probably just any of them. But it's kind of the same thing. A large apartment, a large commercial property, or a portfolio of houses, you need to do even more due diligence. You need to be more careful because everything bigger is riskier. And so it's one of those, like if you have an environmental issue on a one-bedroom house in Waldo, like life goes on, you have an environmental issue on a 250 unit apartment complex where there's like a hidden storage, Chernobyl underneath your property or something like that. That could be a serious problem. But due diligence, I think the first most important thing for me with due diligence on any apartment is, well, I guess the contract is the first and most important thing. So I like that 30-30-30 clause, and I would always put that in. But is the walkthrough, and I always demand a walkthrough every single unit. If you have, and that is even if it's a 200 unit apartment complex, that would be extraordinarily annoying, but I want to see all of them. Because if we only see some of them, we're just going to, you can pretty much just assume the manager or the owner is going to take you through the nicer ones. And the key things when I'm going through these units, one, I want to get an approximate, what I'd call estimate of like the TLC each unit needs. Is it all old carpet? Does it all need to be painted? Does it all need appliances, or is it kind of a mishmash? Give it an approximate how this unit will be about $5,000 to turnover. It's a bigger turnover. This unit's perfectly fine. The turnover would be, probably what the deposit would cover it. This unit is a complete wreck. It would take $10,000, $12,000, whatever. And this is coming up with our total estimate. Like I will have a beforehand estimate when I'm analyzing the property, based on they'll show you a couple units, maybe 2 or 3 units. You can look at the outside. So putting together my estimate, and I have a one-page sheet I use for houses. With apartments, I basically use the same sheet, but I just kind of multiply by things. Like I think each unit needs approximately $2,000 of work. Then there's 20 units, that's $40,000, something like that. Like the bathrooms, they each need a new set of appliances. About $1,200. Multiply that by the number of units. So I want to go. Sorry,
What did you say you do the walkthrough?
The walkthrough of, well, I usually, I say every time I look at a property, I always want to see at least a unit or two. But when we get it under contract, then we walk through every single one. And then we're putting together approximate amount, how much money this will cost. Now, you're not going to be able to do all the work up front generally because it's hard. It's hard to paint someone's unit while they're still living there, and there's often not a reason to. You might want to increase the rents a bit, but generally speaking, we haven't. Some of this rehab expense is it's not really rehab expense. It's just like that your turnover. You're going to have more turnover expenses for a year while you're bringing the quality of the property up. You're also going to have more turnover. If you are bringing the quality of the property up, you're raising rents. More people are going to leave because they either don't want to pay that rent, or they don't want to live there, or they don't want to pay that rent, or they can't pay that rent, So in our experience with inherited residents is the experience I've heard from pretty much every investor. They're not great. And so I always expect to have higher turnover for at least a year after buying a property, any apartment complex. It's going to, or a portfolio. It's going to, people are going to move out more than they would in your other units. Yeah.
So are you prefer the 100% occupied when you buy, or do you prefer like the maintenance?
I mean, I would prefer, with houses, I generally prefer them to be vacant, just because if it is in great shape and there's a resident there and they're paying market rent, that's great. I've never bought one of those. So theoretically, that would be good. So generally, we are fine. It depends on how much, what our occupancy is. Sometimes we had really, we bought a bunch of properties. We're in no rush. We'll let them stay. But this is like, I have this rehab money, and I'm not going to be able to really use it on this property until they move. And so generally, I just like to get houses vacant, unless I'm buying a portfolio or apartment complex. And then I want them to be mostly leased. I would not like, if you're buying a 100-unit apartment complex that's vacant, you have an enormous task on your hand. And the iron law of rehab expenses is they will always be more than you think they are. I've never heard in my entire life one investor complain about under budgeting things, and just be like, or over budgeting. I'm over budgeting. I'm borrowing too much money. I'm putting too much money aside for this rehab. I'm leaving all. That's never the complaint. It's always going over budget, and so. I definitely, with apartment complexes, I want them to be mostly rented, unless we're talking about like a duplex or a triplex. But if we're talking about like 10 and over, especially 5 and over even, I definitely want some of the units to be rented, unless it's just buying it for virtually nothing. Yeah?
When you're walking through each unit, let's say on a 20 unit,
Yeah.
do you have an independent inspector come with you and give you opinions, or do you just eyeball it yourself?
When I go through my walkthrough, I do it myself. And the reason is, if you're going to have an inspector inspect every unit in a 20-unit apartment complex, it's going to cost a lot. What I do then is I list anything that I think is questionable, and then I have an inspector come and look at it. So it's like, I'm not sure about these electrical panels. I'm not sure about this. I almost always get the roof inspected, unless it just looks perfectly brand new. Well, an apartment complex it would be always. Get the roof inspected, get the electrical panels inspected. You know, any questions you have an inspector come. And so it would be like my second inspection. And it's a shorter one where I bring the inspector through, maybe bring him through one unit, and then have him look at the foundation, have him look at the roof or whatnot. Well, if there's any questions about the foundation, I'd get like either a structural engineer or a foundation firm to take a look at it. And so my first stage is to walk through the apartment complex by myself, making a few notes on each unit, getting approximate expense, looking at the exterior, it's not just about the expenses. I meant to mention this. Not just about the expenses. It's also about what is the quality of the resident. Like, part of it is kind of meeting who will be my future residents and getting a feel for them. And you can even ask them questions. Usually they will want you to say something like you're an insurance inspector. You know, they don't want the residents to know that you're selling the property. They're selling the property, and go along. You know, you should go along with that, I guess. But you can still ask them, like, do you like living here? Have you had a lot of problems or things like that? And get a feel for what do residents think of the property? What are the quality of the residents? Do you have a bunch of hoarders? Are there a bunch of drug dealers? Like, I like driving by at midnight, and just seeing like what goes on here at midnight. Sometimes when you're there in the day it looks fine, and when you're there at midnight it doesn't look so fine. And so those are some things I want to look for. And then I usually come back with inspections to actually look at specific things. I want to always check out the roof. The HVAC might be perfectly fine, so I might not need that. But and as I've gotten more confident in my own abilities, I've used inspectors less. But especially for newer investors, I definitely recommend inspections. But I usually bring the inspectors out second after I've looked at everything, and then I bring them out to look at specific items. Yeah.
Would you walk through each individual unit?
Yeah, I want to see them all. We did buy one portfolio of houses where we didn't walk through each, but that was basically because that was a key selling point. Like, he didn't want to go bring us through every single house, and so we thought it was a really good deal, and so it made sense. But that's pretty much the only. And like, it was basically he was basically selling us he was trading a lower price for us not going through every single unit. And that's really the only way I'd consider it. I want to see all of them. I mean, I figure if they're going to show me half, I'm going to see the better half. That's just the assumption I make. You get a little bit cynical in this business. Spoilers.
You said that you go the first, initially write it down, and then you bring the inspector. Do you show every unit to the inspector, or just certain unit you want to show to the inspector?
I don't show them every unit. I'm looking. I make a list of what I think is the issues that will need to be, what expenses will need to be put into the property when I'm going through the first time, and maybe a quick like mark about the resident, like, is the resident a hoarder, or is the unit in terrible condition, things like that. Then I'm looking at specific things like these furnaces look really questionable. I want to have an inspector take a look at them. The electrical looks questionable. I want to have an inspector look at it. Maybe have the inspector go through one or two units in full, go through every little bit of these 2 units, because they should be like, if there's a general issue, you should catch it there. If there's a basement there, probably have them look at that, see if there's any sign. Do you get a pest and dry rot? See if there's any signs of termites and something like that. That's stuff I'd have them do, like the general stuff for the buildings and maybe a few units, and also particular items. But I'm not going to bring an inspector through 100 units. The bill for that is going to be extremely expensive. I don't think I'd want to read that report, and I don't think you're going to learn much from the 17th unit. It's going to be very similar to the first. I mean, yeah, the 17th might have an issue with this light fixture, whereas the first doesn't, but you've kind of got the idea.
The inspector tried to call you, unit, whatever you show.
I mean, when you're doing an inspection like that, it's probably going to be fairly negotiable. I mean, like if you're getting an inspection on a house, it will be a couple $100. If you're getting an inspection like that, it's probably a little bit more negotiable. And you just have to ask for a quote or what they would charge you for what they're looking at. Because a lot of times, you definitely the big thing with inspections, I want them to look at the big ticket items. What are the things that really cost me? Drywall's really going to cost me. Termites are really going to cost me. The roof, the furnace, or the HVAC systems, the electrical, the plumbing, these kind of major systems in the property that could really hit me. And then the phase one for any large apartments, that's looking for environmental things like underground storage tanks and stuff like that. If the property's built before 73, you might get lead, check for lead. Although that's not 78, sorry, 78. And that's not real estate agents know that. It's not a disaster if it has lead in it. You just need to be careful about that. It's like, it might cost you a little bit more if you're going to be repainting the exterior. You got to get a lead certified painter to do it, which is going to cost more than just painting it with, if you can just strip and paint it. We've got to actually come out with put all that plastic outside the property so they can catch all the chips that they rip off and stuff like that. So there's just more expenses with that, but lead is not the end of the world. But you do want to know those things. Then you also want to look at the financial, and one of this is just inspecting all the leases. You want to see make sure the rents are equal to what's on the rent roll. You want to check to see when is the rent late, and is there a late fee? If there's not a late fee, that's a problem. And so are they month to month? Are they year leases? If they're all month to month, that could be a problem. You definitely want to check with the bank if that's a problem. But you want to know this going in. But you want to verify everything that's on their rent roll and their operating statement as much as possible by reviewing all of their leases. Do they have weird clauses? I mean, I've seen like these ma and pa leases where it's like the resident is not charged a deposit, but they're expected to do the maintenance themselves. And it's like, no. It's like you don't want to have anything like that. Do they have pets? That's something to also check for when you're walking through the units. There was one appraisal we did where we got there a little bit early and we went into the basement and they must have had, I don't know, like 30 or 40 baby pit bulls. And so that was like, I don't think we were supposed to see that. And then while we were there, somebody came to pick them up and take them away, and they just did this right in front of us. I'm like, yeah, it's too late, buddy. So, but if you're walking through, like if you do have someone breeding pit bulls in this apartment, you want to know that. And then when you get these leases, are they charging pet rent? Do they have pet deposits? Things like that, and just verify the deposits, because the deposits will be transferred to you upon closing. Verify the pet rent. You just want all the key items you want to verify from the leases. That is even more boring than walking through the entire apartment, is reviewing all the leases. So, but you just kind of gotta get, real estate can be a lot of fun. It can also be kind of boring sometimes, and you just gotta. But the boring parts are really important. Yeah.
How much is a customary earnest deposit?
The earnest. Usually it's about 1% of the purchase price. I mean, it's all negotiable. So if we're offering like on a $700,000 property, we should put $7,000 down. Now they might want more, and that might be something to negotiate with them with, but it's usually about 1%. Yeah.
When you look at the inspected, you have a problem tenant.
Yeah.
Or late or don't pay or whatever the problem. Do you, before you buy, do you tell the seller you need to move them out first, or just you take over and move them out?
No, we wouldn't. I mean, if I have a resident that's behind on the rent or we know is a problem, I basically look at that unit as being less than vacant because it's going to cost money to get them out. But the time it would take them to get them out, evictions, particularly in Jackson County, take quite a while. If they haven't even filed for an eviction, it's going to take even longer. If they're not behind on the rent, but they're just a problem resident, but they're under lease, it can be very challenging to get them out. And so it's like, that can slow up a sale for a long time. So no, we would just assume, we just take that into account when we're analyzing the property. This person is behind, that's like negative occupancy, like it's worse than vacancy. A vacant property is better than a one that's rented to a bad tenant. But we just we buy it as it is. Yeah.
Can you give some examples of the ones you walked away from? And then also your package deal that you didn't look at every one, did it backfire at all?
The package did not backfire. It was there were more repairs than we thought there'd be, and so that backfired in that way. But it was a really good deal, and we thought we did have a lot of equity, and so it still worked out well. But it did kind of, in the way that it didn't work out, it was in exactly that way. It was more repairs than we thought. The biggest deal we backed out with was a 74-unit apartment complex in South Kansas City. And we backed out when we went through all 74 units. We found several problems. One is they had these old Federal Pacific electric panels, and they say FPE on them, which are basically useless. They don't trip. And so electric panel doesn't trip, doesn't really do anything. And so, you have a power surge, it will send it all through it, right to you. We noticed that, which we missed on when we went through the first time. And then we also, not all of them were FPE, most of them were. There were a lot of issues with their patio doors. The patio door, not all of them, but a lot, not the ones we saw, but a lot of them, you can see when you look at a patio door or a window, if it's fogged up, that means it's shot, it's broken, it's getting air from the outside in between the glass. And so we noticed that probably most of the patio doors needed to be replaced in this property. We also found some signs of rot, and a lot of the residents were talking about how the heating was really bad, and this was just from talking to people, how do you like living here? Do you have any complaints? Consistently, we're hearing this, that they had all these issues with heating and cooling. There was one other major issue with the property that's escaping me at this second. Oh yeah, this was fun. So they told us that the property, it was at 77% occupancy, and they told us they were leased up to 90%. And I think they were leased up to 90%, but they forgot to mention that they also had people moving out. So they were right back at 77%, or actually it was less than that, it was like 74% when we got it under contract. And in addition, the leasing office was counted as a unit, and so was a maintenance shop. And so this is not uncommon. They will often say it has 70 units, 100 units, and they're counting the leasing office. So you always ask to see if the leasing office is counted as a unit or not. And so it was really a 72-unit apartment. The occupancy was less. There were a lot of repair and maintenance issues that needed to be done. And so we started off by considering asking for a reduction in the price. And eventually we realized we're not even sure we can finance this, because banks generally want to finance something that's 85% or above. Anything else than that is kind of usually bridge financing or something like that, or property. This is basically moving into reposition territory. And banks, first of all, that was a while ago, and banks weren't anywhere near as interested in lend as they are now. And you're also looking at reposition territory that's more like bridge financing, then you're having to pay for 2 loans and much more expensive interest rate up front. That kills. The deal is killed from every direction. And so, that was, it was really looking at, I'd say on that one, we didn't even get to the inspections. We could see all these problems ourselves. And then we also saw on because you want to ask for the rent roll and operating statement each month, even while you're under contract. You want those updates. Just getting those even before we got to the leases themselves. So that was the biggest one we've backed out of. And it's really, a lot of times it is the deals you don't do that determine whether or not you have success. So I think that deal would have, because it was a while ago and properties have appreciated, it would be worth a lot now, but I think we would have just been sunk into that one. It would have been extremely difficult, especially if we had tried to syndicate it and bring in private investors to help to finance it, because we would have had to go back to them or reach into our own pockets to bring money there. Yeah.
You requested to the seller, I need to see the operating expenses.
Mm-hmm.
In that case, if they don't give it to you, what do you do?
If they don't give me any operating expenses, I am going to assume the property is operating horribly, and they're going to get a much, much lower offer. I'd say the more gray areas you have, the more the more questions you have, like it's kind of like when you're looking at the question I get sometimes with properties that are more rural or don't have a lot of comps near them. Like, what do you do if you're not confident in the value? Well, if you're not confident in the value, that means you have to assume that it could be worth less than what you think it is. You're much less confident. You need to be more conservative. Any piece of information you can't get along the way, that just means you need to be more conservative in your offer. If they don't give you any, I mean, it's very weird for them to give you nothing if they have tenants and stuff like that. But I just assume there's a lot of problems, and the offer is going to be substantially less if I can't get that information.
3 years ago, I tried to buy the 5 units.
Yeah.
And I requested them, and they don't give it to me. So I said, okay, I'm done. I don't know how much you're spending.
Mm-hmm. Yeah, I think generally, and this goes with selling too, the more information and the better information you can give when you're selling a property, the more likely you're going to get a better, higher quality, higher offer. And it works the same way with buying. If I can't get good information, they're not getting, it's got to be.
What they're saying is because there's privacy with my operating, so they don't want to, they don't want to give it to you because that's their own.
Yeah. Well, here's how I put it. Like, for real estate agents in the room, if you see an MLS listing and they don't have a picture of the house on that listing, what quality do you believe that house is? Is it good shape or not so good shape? I think that's pretty much the same way to look at it. Yeah.
So in the lease review process, you already have your offer in, and now you're doing your due diligence. Because for them to give you the actual lease for you to review.
This is under contract.
Okay.
Yeah, this is after we're under contract. Beforehand, I want the rent roll. And so the rent roll is just a list of all the people. I mean, they can give you names. I've had people like redact the names before, but usually they'll just give you the names. What the rent is, are they behind, what the deposit is, when does the lease end? That's basically the information I'm getting. When I go into the lease, I'm looking, and then I'll ask them, like, are there any weird terms you have, things like that. Do you have pet rent? Do you have many residents with pets? Or Section 8, do you have that on the property? Things like that. So I'll ask them those questions, and then I'm looking to verify all the information I have. Make sure the way to think of due diligence, you have this image of what you think the property is in your head, and you're trying to verify that. Make sure that it is what you thought it was. And if it's not, if it's better, great, that's wonderful. If it won't be. If it's worse, then you need to ask for a reduction in the price, which is called retrading, or you need to just back out. Yeah.
What are your thoughts on program rents like Truman Medical or Restart or even Section 8?
We've done some work with like Save, which has like in one of our apartments, and that has worked pretty well. Section 8, Section 8, we have that in a couple. There is this one Section 8 I once heard of that is slow and doesn't ever answer your calls, and if you leave a message, they will never respond. And it takes months and months and months, and if you don't cross a T or dot an I, then you have to start over. That Section 8, which is probably maybe like, I don't know, like Michigan or something like that, that one is not very good. We don't work with, but we work with the other ones. But the way I think of it is I'm going to evaluate them in the same way I evaluate anybody else, other than their income. So whenever we're doing, we manage our own properties, and we have very strict rental criteria, and it's all very important. Screening is the most important part of management. Screening and maintenance. If you get those two things right, that's most of it. I mean, there's collections and other things, but those are the most important two things. And so we always demand, no felonies in the last, basically, they go back 7 years. So no felonies in the last 7 years, other than we will accept one DUI. No evictions, we 3 times the income and rent, or 3 times the rent and income, and good landlord history, no more than 1 late pay over the past 12 months, good landlord references. So that's what we want. And the question, we want the same thing with Section 8. Like, so, other than income, we know they don't need to make as much income because maybe they're paying less or nothing, and so they wouldn't need to make as much. But other than that, we want it to be the same. We're not going to go reduce our standards for Section 8 resident. I think that's where Section 8 landlords, where Section 8 can get a bad rap from landlords, is because a lot of landlords will just accept Section 8 more readily because the rent is guaranteed. But then you get them tearing up a unit. But if you have the same, there are good residents that have Section 8, But I think you just have to screen them in the exact same way, other than income, that you would others. Yeah.
Can you describe your current portfolio?
Yeah, it's we have about just under 500 units, about 300 houses and 200 apartment units, more like 160 apartment units. About
And
that.
you say we a lot. Who is we?
We is my brother and my father, so Stewardship Investments.
So
Also.
small.
What is
Yeah,
it?
my brother Bill and my brother Philip and my father Bill. Stewardship Investments, although our management company is 333 Rent. Yeah.
So your father moved from Eugene?
My father stayed in Eugene. I moved, and then my brother moved afterwards. Yeah, so my dad's still in Oregon, and he does student rentals and stuff like that out there. Yeah.
Okay, one of the questions. Before you bought, or when you bought, after bought, and you think this rent is so low, and you think it's so low, when do you increase?
I mean, I think you want to increase fairly quickly. I don't see any reason to. I mean, I would put it this way: I would do the major repairs first. So, for example, we bought a 32-unit apartment complex. It needed a lot of exterior work. It needed a new parking lot, or the parking lot was in terrible shape. It needed some foundation work, mostly foundation shoring up, to make sure that that didn't get any worse. All like balusters in the res, all sorts of things like that. We did all the exterior work, and then we started fixing up the units as they went, and then we started just increasing the rents. And so it's like, once you start increasing the rents, people will generally they'll either move out or they'll demand that you fix up their unit, and then at that point you make a decision. Yeah, but I would generally do the common areas in the exterior, and then start fixing up the vacant units, and then increase their rent, and then it kind of depends. Generally, I'd say go pretty quickly. There's no reason to, once their lease is up, you increase their rent. They'll probably either move out or want you to improve their rent. You can either have them move into a different unit, or you can find a way to fix up their unit while they're living there or something like that. But that usually hasn't been a problem for us, because we got ahead of ourselves, and so we just kind of went at a natural pace. As people moved out, we fixed it up. So if you're wanting to reposition a property, you want to do it relatively quick. But if you're not that, like, they're paying rent and you're not in a rush and you've got other things in your head that you're dealing with, which is kind of our situation, we just kind of, like, as it happened, we would fix up units as they moved out, and it kind of in between it, like, so. We would increase the rents, but we wouldn't increase them up as much as we had a brand new fixed up unit kind of thing. So it kind of depends on your situation. But if you're just like, you're buying this apartment complex and repositioning it, I would do it quickly. Like I would exterior and common areas first, and then the unit, because to raise rents, you need the exterior to be nice. Like that's like, if the exterior is a mess and the units are great, that's not how you get the high rents. You need the exterior to be good. And so you do that first, and then the units, and then the vacant units, and then I'd move to the increasing rents in the occupied ones, or fixing up any ones that moved out.
What's the ideal way to find properties?
Yes. Okay. One, if you are going to be buying commercial properties, you need to be on CoStar. Like CoStar basically has a monopoly right now. They bought LoopNet, and then Xceligent went out of business, and so I think they're pretty much the only one. So they will have all the listings, and I think you want to start seeing who the big players in commercial real estate are. I'd go to the CCIM meetings and start meeting with the real estate brokers there. Get on their lists too. But now those are going to be mostly market. Well, they're going to be all market properties more or less. If you're going to be buying apartment complexes, I'd say the best source is sort of the ma and pa person. And there's no reason you can't approach this in a similar way that like homeowners or people buying houses do. In fact, I have a friend in Indianapolis who he's bought a lot of mid-sized 5 to 10 unit apartments, and he's done it the same way, mostly mailing out-of-state landlords. That's a good list. That's good for any of them, out-of-state absentee landlords. Some of them they're fine with it. Some of them are like, you're just really tired of that property and are willing to sell it at a discount if you can buy it quickly without any hassle. There's things nowadays where you can send out text messages and stuff like that. Or, I get like 4 calls a day from solicitors. I don't recommend that, but text messages I don't think are that bad a thing. I would, keep your eye on Craigslist. Every once in a while you'll find something. That's much less common, but every once in a while there'll be something there. They do. There's auction.com. There's foreclosures of apartment complexes too. Those are rare, especially in this environment. And usually what you'll see at the auction, the county courthouse steps, are houses. One of the best ways to do it 7 years ago was going directly to banks, and the ones that had REOs. That is much less common now. I think probably the best source are the kind of out-of-state absentee owners that have generally ma and pa types that have apartments they don't like dealing with, they're tired of, got some problems, they need a minor reposition. So we're not looking at the one I would be interested in. I don't want an apartment that's a train wreck. I want a house that's a train wreck, that's fine. Apartment I'm not interested in. Maybe you are if you're willing to a little bit more risk tolerant, want a bigger risk, bigger reward kind of thing, have some money to spend or some investors with money to spend. We're looking for minor repositions, things that we can raise the rents after we do some moderate fix-ups to the exterior and to the units themselves. And I think probably the best source at this time are out-of-state absentee owners. But I definitely think it's worth getting in touch with all the major brokers, getting on their lists, getting to know them, there are wholesalers who have they mostly have houses, but I've seen apartments from wholesalers as well. And also keeping your eye on the MLS, keeping your eye on Craigslist, keeping your eye on CoStar, which is really important for that.
In terms of back to financing for a second, so like on a 10-unit apartment building or 20-unit or even 30-unit or something like that, from what I understand from what you're saying is it works differently in the financing than it does with single-family homes. Like there isn't like this interim bridge financing, you're just financing it straight from the beginning.
I mean, you could do a BRRRR, just the traditional, we have done this, I should have mentioned this, where we buy an apartment complex with a private loan. This is not a 50-unit apartment, this is like a 4-unit. So we just get a private loan on it. Or you could get a loan and you get a second on it, like a private second on it, if somebody was willing to do a second. Now, it's a harder sale to get a private lender to do a second. You probably have to pay more interest, but there are people who are willing to do it, especially if you've built up some trust with them. So you get a bank loan for the first, private loan for the second. And then you fix it up, get it rented, go to a bank and refinance it. So there are ways to do this strategy in the exact same way as you do with a BRRRR strategy, the exact same way with apartments that you do with houses. But I would just say there's a little bit more risk because while you have more opportunity to increase the value with apartments because it's based on the income, not based on the comparables. It's based more on it's based on the comparable cap rates. And since you have more power to change the cap rate, you have more power to increase the value of a property. But it's also a little bit more subjective and it's tougher to value. It's tougher to compare them. There's more questions about, there's no cookie cutter, well, they're very rare to have cookie cutter apartments that are exactly the same. And so it's a little bit harder to know where it's going to come in at. It's also harder, despite being conservative in your rehab estimate, and I didn't talk much about this, but I would definitely recommend whenever you're putting together a rehab estimate up front, double checking that when you go through each property, basically doing it again. I always recommend adding a contingency to it. 20% is my recommended. So just things, what you think it's going to cost, adding up all those line items, add 20% to it. Because you're going to find stuff is going to go over budget or things you didn't think that were going to be there, stuff like that. And also account for holding costs. If you have a vacant house, you're going to own it for a couple of months with a private loan on it, that's going to cost money. That's part of your budget. Same could be for an apartment that's only 50% rented. It's going to be bleeding money for a while. So you want to count all of those things in there. Getting back to your point, you can do this traditional BRRRR strategy with apartments. But if you're buying these bigger ones, I mean, it would be, I've never heard of somebody getting a private loan to cover 100% of the expenses of a 100-unit apartment complex. Generally it's going to be a syndication or somebody who has fairly deep pockets and can put down that down payment on their own. Yeah, that's kind of when you're moving into that gray area. I think most of the ones I've seen that way are bought with people who just have a bit deeper pockets and whatnot. But especially if you know you're getting a good deal, have the opportunity to increase the rents, you could get a second from a private lender, or you could get, you can syndicate a property at that. It's a little bit smaller, so that your legal costs will be higher per unit because syndication kind of has a floor of how much it's going to cost. But yeah, it really, I'd say financing can be trickier with those apartments. One of those things is you can have, I would never recommend the BRRRR strategy if somebody has no money, because things go over budget. So you need to have some money to cover that. But with BRRRR strategy for houses, you could have 25, 30,000 or something like that. The bank is probably going to work. Apartments, I would want more, especially. But I guess the with a 10 or 15 unit, it kind of depends. I mean, if you can put down, I would say if it went to 20, then yeah, that's perfectly fine. I think to syndicate, you probably can find only one investor, to put the money down. With a 10 unit, if you're getting a really good deal, maybe you could get a second for part of it. You can maybe get a second, maybe put some, or maybe get a partner and just split it 50-50. Like if you have enough money to put down for half of it, or you feel comfortable putting down half, then you can just split. Instead of doing a syndication, which is a partnership with where the equity is not based on what you put in. As the lead investor, you can just do a traditional partnership, which is not a security. You don't need any of that security stuff, where you just put in half, and you find a partner, and they put in half. So there's.
Yeah. You can't go to like the bank and say, hey, can you give me a loan? Loan to cost.
Oh yeah, you could do that. 75% or maybe 80. Yeah, you can that.
And then refi it.
Oh yeah, you can do that for sure. I would say the reason I lean a little bit against that is because commercial loans are, it's expensive. The appraisals are expensive. The cost, everything's more expensive on a commercial loan generally. But you can, and certainly at some point, like the Woosters I know have bought properties in 2011 when they were like comically cheap, and then 2014, 2015 or something around there, they refinanced them. But that wasn't really, it was sort of part of the strategy. It was mostly just like, let's pull the money out. It's a longer term. Like once you refinance them, especially with the syndication, you refinance out all your investors' money. Now they have all their money back, and they're still getting a return. And that's, that will make your investors very happy. But that was 4 or 5 years down the line. Instead of with the BRRRR strategy, I'm trying to refinance in 6 months. And it's like you can do that on an apartment complex, but I don't think it's generally not as applicable. Like with with the syndication, like the whole point of the BRRRR strategy is to not have any of your money in the property. If you syndicate a property, you don't have any of your own money in the property unless you choose to put some of your money in there to maybe put some skin in the game to help convince investors to get on board. So you've kind of already done the refinance out part. The whole point of refinancing on the BRRRR strategy is to pull your money out. If you're syndicating, you don't have any money in, so you don't need to pull it out. And you could say that if you're using a second from a private lender, yeah, I'd want to get that second off as quickly as possible. So I would want to refinance out if that was doable. If you're putting your own money in, it's kind of like, when do you think? It's when do you think, like, do you want your money out? Like if you're an active investor, then yeah, as soon as you think you can get it out, I'd refinance it. If you're a passive investor, or you're just looking for one a year, every couple of years or something like that, then maybe not. If the interest rates are a lot lower, sure. If they're a little bit higher, then it's probably worth just keeping what you have. So it's a little bit more situationally dependent. But I'd say with syndications, if you're doing a syndication, that is different than the BRRRR model. Or it's the BRRRR model without the last R. There's no point to refinance until you're at the point where you can just pull all of your investors' money out. And that's important to them. I guess the last R is not. I guess the way I'd put it is this: the last R, the strategy is not contingent on the last R. The last R, the refinance part, is more just when it makes sense to do. And so I would say that definitely financing apartment complexes is trickier than financing houses, for sure. There are some more opportunities because of the big banks who offer better rates. But the down payment can be very tricky with apartment complexes, especially if you don't have a lot of cash. Yeah.
So when you look at your portfolio, what are a couple of the reasons why you want to get rid of something today?
I mean, I think there's a few reasons that you'd want to get rid of. One is if it's just performing really badly and you have reason to think it will continue to perform badly, then it's probably something that you want to get rid of. If it's a major management headache, like we had an apartment, an 8-unit in an area that was just causing all sorts of headaches, it was a really high crime area. It was one of my earlier decisions, not a good one. We sold it. And then a month later, my property manager sends me this story about how there was like a shooting next door, and I'm like, okay, probably a good thing to get rid of that. Another one would be if you know, like this property has a lot of equity in it, and I want to pull that equity out, and maybe it makes more sense to do it. Like, you know, you're going to pull more out by selling it than refinancing it because they got to leave 25% in. So if you think you have better opportunities, another one would be is if you have this would probably more so with apartment complexes, or maybe if you have if you're not getting a very good return on your equity, like you might have a lot of equity in the property, but you're not getting much cash flow from that. Like, is it worth trying to put that into another property that gets a higher cash return? I mean, there's all sorts of metrics you can use. You know, we've bought some condos before, and the only ones we bought have been good deals, but they don't cash flow very well, so I don't generally look at them. And we have sold a couple because the HOA can often kill any condo deal. So, I mean, I think the biggest one is if it's not performing well, you have reason to think so. It's in a bad area. You want that equity. You want to get that equity, or if it just doesn't have a very good cash-on-cash return, and it makes sense to take that equity and move it to something that has a better cash-on-cash return. Yeah.
How does it work if you have free and clear properties? Take it out from as a collateral. How does it work?
Refinancing?
Not refinance. I don't know. Some people said if you have free and clear property, we can take out the money from there. We can buy maybe down payment or something.
Well, you would need to refinance that property or get a line of credit on it. You could get, if it's a house or your home, you get like a HELOC, a homeowner's line of credit, where you can borrow money against it and then pay it off and kind of go up and down. Or you could just refinance it and pull out 75% of its value.
Free and clear, still need to refinance it.
If it's free and clear, it just means it doesn't have a loan. So you would have, if you wanted to use it to purchase something else, you would need to pull the money out of it. I don't know of any bank that would let you use a property as collateral. Maybe a weird private lender would, but I wouldn't. You would need to pull the money out of that property with a refinance or a line of credit, or either getting a refinance in it or getting a bank to put a line of credit against it.
But putting a HELOC, I think that they allow only for the homeowners. I mean, living there, not like properties, investment properties.
Well, homeowner's line of credit would have to be on your own house. There are we don't have one, but I have heard of them. We were offered at one point getting a bank putting a line of credit on an investment property. Like U.S. Bank talked to us about this possibility. Instead of refinancing it, putting a line of credit against it, where you can go up and down. Actually, we do have one of these in Oregon, so those things do exist for investors. But
U.S. Bank was allowed to do that way?
What's that?
U.S. Bank?
U.S. Bank talks to us. I can't guarantee that they would offer it, but it's something that banks do sometimes. Yeah. Yeah.
Can you tell me about your most profitable favorite multifamily deal in Kansas City over the last 2 years that you've done?
Most profitable multifamily would probably be that 32-unit apartment complex I briefly mentioned. It was we bought it in 2015, and somehow we bought it for $23,000 a unit. It didn't need a decent amount of work, but we're into it for under 30, or we're into it for about 30 a unit, 30 and change. Yeah, about that. And it's worth substantially more than, I mean, pretty much any apartment is worth over 40. It was weird. It was actually on LoopNet, which was shocking to me. Like, we were just kind of scrolling. You know, this is why I say, you know, a lot of people be like, there's nothing on LoopNet, there's nothing on Costa. It's all been picked over. Most of it's been picked over, but I still think it's worth looking at those things because sometimes you catch them. And this one was just there. It was a Mon-Pa type, and it was, you know, they all these funny things, like they had mismatched carpet because they'd get remnants, and like they got like mistinted paint, like for really cheap. and so all the walls were colored different. So we had all these weird, goofy things, but it was, and I think that probably spooked some of the other investors, as well as the fact that you have the big investors looking for big properties, you have regular investors looking for houses. I think sometimes those mid-sized properties can get missed, especially if they're not in like Hyde Park or something like that. And so that deal worked out really well for us.
So can you tell me like what the purchase price and what the rents were, and then did you rehab it?
Yeah. The purchase price was $720,000. The rents generally were, for the one bedrooms, were about $420, and for the twos were like $460, I think, $465. We've raised them, I think, to about, I think $495 and $540, and so. And then, I mean, mostly like we redid the parking lot. We shored up the basement, and then we've had sizable turnovers on each of the units because the paint, carpet, and stuff like that. But it's been a good property for us.
How long was it?
That was in 2015 when we bought it.
15?
Yeah, so it was about 4
Where was
years.
this at? What area?
South Kansas City. Yeah.
What are some things that you do when you go to sell your properties? What are some things that
We don't sell. We have sold a few, but yeah, but I can give you a couple ideas. Yeah.
What are some things to do to minimize
Taxation? Well, I mean, the big thing would be to 1031 the property into another one. And so when you sell a property, you can do a 1031 exchange, and that you have 45 days to select up to 3 properties, and then it was 120? I think 120 days to close. And so once you sell a property, if you can put all of your proceeds into the next property, then all that tax is deferred, and you don't own any capital gains on it. For one thing, if you own a property, 1 year, you buy it and sell it 6 months later, that's personal income. But if it's over a year, it's capital gains. That automatically will reduce the price a bit. So if you're on the edge there, I would wait a little bit longer to get over a year. And I mean, you can. The big one is the 1031 exchange it. And then also, I mean, one of the best parts about being in real estate is that your depreciation counts against your income, at least your real estate income, and so that's the best way that pretty much eats up all of your income tax. But with regards to reducing the amount of taxes you pay on proceeds, I'd say really the thing to keep in mind is the 1031 exchange, because that's, I mean, if you have that gain, you have that gain. There's no really way around it. So the best way is to use the tax code to your advantage. And I think in this, the longer you can defer taxes, the better, because you can make more and more. Making a return on a higher number is going to be bigger than making a return on a smaller number after you get taxes paid. So as long as you like real estate, I'd stick with real estate and use those proceeds to buy the next property.
Was it effective for the tax increase this year? Did you file this?
Oh God, yeah, I filed I spent days on that, and then now it sounds like they might. Did anyone know what happened with that? Did they put through there was a move? What?
They extended it.
They extended it, but they also put through one of the committee members put through a motion to cap it at 14% increase. I don't know if they voted on it yet. Anyone heard about it?
Voting today.
Oh, they're voting today, which means they probably already voted. Right. So I guess let's Google it afterwards. Cross your fingers.
Every house is going to be increased to 14%?
Yeah. If it passes. No, max at 14%.
More than 14.
Yeah. Yeah.
So, now a friend asked for advice. He's got $170,000 cash. What would you recommend him to do? Flipping or?
I think lending to me makes the most sense.
What's that?
No, what would I recommend?
Signing people, whatever, roofers.
Yeah.
He's got.
I mean, I think as far as investment goes, I mean, I would probably start with smaller properties, houses, duplex, fourplex. Look for a BRRRR deal, but that's a good position to be in. Like I don't think a reason not to do the BRRRR strategy. Like I don't know why you just buy and hold instead of buy and hold with a good deal where you could. And then he's got enough money where if he makes a mistake and he's all into it for a little bit more than he would prefer to be, you can always sell at that point, but he also has the cash to handle, being all into it for 90%, refinancing. So I would probably start with, the house to fourplex, start in, working to middle class areas, avoid the war zone, really avoid really, tough areas that you really got to specialize in. And, and if he's looking to move somewhere, FHA's got a great program where you can get 96.5% financing on up to a fourplex. So it's a small apartment. That's a really good way to finance those types of properties. And you can only do it if you move in, though. So I guess he doesn't need to because he's got some money, but that's something to consider as well. But I would say the smaller property range until he gets more experience in investing, and
So no flipping, just buy and rent. Is that
oh, if he wants to flip, yeah, go for it. I mean, I like holding. I mean, I'd say with flipping, you want to be a little bit higher in properties because, if you're buying in the buy and hold range, working class, it's going to be kind of a mix of like probably 60, 70% rentals, 30, 40% owners, to middle class where it's probably like the reverse. And you get in those higher end areas, that's where you want to be generally when you're flipping because when you get more bang for your buck, and it's a lot more homeowners, and so that's where there's the more opportunity to get higher sale prices and not fighting around with investors for really good deals. I'll do one more question, and I think we'll probably need to wrap up unless I just happen to say that when there are no more questions at all. All right, we'll do two. Okay, go ahead.
So you manage your own properties.
Yes.
Can I ask what software you use?
Rent Manager. Yeah, Rent Manager. Yeah, and so I think it's pretty good software. I think if you only have a handful of units, I think probably Buildium or I always forget that. It starts with an A. Appfolio. I think those are good ones. But Rent Manager is good. I think it's for a bit bigger portfolio. And then if you have like a big apartment, Yardi or One Site are probably the two to consider.
Did you say Rent Manager?
Rent Manager is the one we use.
Oh.
Yeah.
Okay. What's the other one? Or
Smaller, Buildium or Appfolio. Buildium. Yeah.
Can you share us the most worst experience when you find people wrong or whatever, the worst?
Yeah, I mean, I think the worst one we bought was, the worst property we bought was this house in Grandview where the basement was probably half finished, and so I thought we'd just go ahead and finish it. But like we had to rerun all the electrical and like cut into the basement floor to redo the plumbing, and it was like, and then there was water getting into the basement too, so we had to shore up the foundation, and we went over budget by 100%. And so this is not quite, it was like 80%. Yeah, so it was, that's one of the finished basements are not worth much to me, and I would never go through finishing the entire basement, generally speaking, unless it's a walkout basement. That would be one to consider. But it's also one of those things, budget, and we probably, that one I think we should have seen how it was not in good shape and actually gotten in. On houses, I don't always get inspections. On that one, I should have gotten inspections. So it's a good case. Do your due diligence. Check all of the systems better. Finished basements are not worth your time, and what other mistakes? Yeah, I didn't have a contingency on that one, so put in a contingency.
What was the inspection at that house? What did you experience?
There was no inspection on that house.
You didn't?
I don't always get inspections on houses. Yeah, so early on for any new investors, I would recommend it. Okay, Aaron, I'll let you, and then we're gonna finish up.
I'm gonna lovingly borrow this from 1 Million Cups. And typically, it's one of the last questions asked. But what is something we can do as a community to help you grow your business?
Well, you got money, you can lend it to me. No. I mean, I would appreciate, I think the biggest thing is just, networking in general, but referrals for contractors, banks, lenders. roofers, I think just sharing really good people that in the business and in the trades, banks, anyone that that work with has done well by you will probably do well by us, and vice versa. And so that kind of thing. I mean, we always need more contractors, banks, and things like that. So if you have good contacts in that area, we're always interested. Or if you have somebody somebody who's looking to lend some money or would be considerate, I mean, I'd be happy to talk to them. So any contacts in the field are great. I mean, of course, I like sharing war stories and like that. It's always good to learn that way too. But I think good referrals are always appreciated on my side. Yeah.
Thank you.
Absolutely. Thank you for taking the time.